Hi everyone, in this video we will be going over A-Level Accounting 2023 February-March paper 3-2. So this is a structured paper 3 which consists of 3 questions and all of them are of 25 marks. We're also given a time limit of 1 hour and 30 minutes, which means that ideally we should be spending about 30 minutes in order to solve each question. And in this video as well, we will be attempting to solve this question number 1 in under 30 minutes. And I will also link down the question paper as well as the mark scheme in the description box below. So without any further delay, let's get started. J Limited is a manufacturing business and it applies a rate of factory profit of 20%. The following information is available for the year ended 31st December 2022. We're given the sales revenue, purchases of direct materials, direct labor, factory overheads, administrative expenses, selling and distribution costs, increase in direct materials inventory, decrease in work in progress inventory, as well as the increase in provision for unrealized profit. We're also told that the finished goods inventory at 1st January 2022, so this is our opening balance of the finished goods, and this is at the transfer value. So transfer value always includes our cost as well as the profit, and it's given to be 26,400. Let's have a look at our first question. We need to explain 2 reasons why a business may apply a rate of factory profit. So the very first reason is that the transfer price can benchmark with the price at which the goods could be bought from external suppliers. And there are questions in the past papers where some of the goods are produced on your own while some are purchased from external suppliers. And this is because it provides relevant information to the business to make decision whether the goods should be produced by the business or bought from external suppliers. Let's write it down. The transfer price can benchmark with the price at which goods could be bought from external suppliers and this provides relevant information to the business to make decision whether goods should be produced by the business or bought from external suppliers. Now, the second reason to apply a rate of factory profit is that it allows responsibility accounting in the business. Because if we apply a rate of factory profit, this means that the manufacturing department is also treated as a profit center. So the costs have to be controlled. Let's write it down. This allows responsibility accounting in the business. And the manufacturing department is treated as a profit center. So the costs have to be controlled. Okay, this concludes the first part. Let's move to the second one. We now need to prepare the provision for unrealized profit account for the year ended 31st December 2022. Okay, so this is the provision for unrealized profit. Which is a T account. Now, the only items to be recorded in a provision for unrealized profit account will be our unrealized profit for the opening balance of finished goods as well as the unrealized profit for the closing balance of the finished goods. So let's have a look above. We already have our opening balance right here to be 26,400, and this includes both of our costs as well as the profit. So in order to figure out profit from the transfer price, we have the formula profit equals to transfer price times rate of factory profit divided by 1 plus rate of factory profit. In this case, we have the transfer price of 26,400. We are given the rate of factory profit to be 20%, so we can write it down as 0.20 divided by 1 plus the rate of factory profit, which is again 0.20. And this gives the profit or the unrealized profit for our opening balance of finished goods inventory to be 4,400. And we are also given the increase in the provision for unrealized profit, and this increment in the provision for unrealized profit is always to be recorded on the credit side of our provision for unrealized profit account, but under the heading of our statement of profit or loss. So we can just figure out our closing balance. That is going to be the opening balance minus the decrease or plus the increase. In this case, we have an increment. So the opening balance of profit is 4,400, which we just figured out. There is no decrease. There is only an increment of 600, which results in the closing balance of our unrealized profit to be 5,000. So these are the three amounts to be recorded in our provision for unrealized profit account. Let's do that. The opening balance is always to be recorded on the credit side. So that's going to be our balance BD, which we just figured out to be 4,400. Then we were given that there was an increment in the provision for unrealized profit, which means that this should go towards our credit side, which was of 600, and we can write it down under the profit or loss. And then we have our closing balance, which goes on the opposite side of the opening balance, so the debit side, and we figured it out to be 5,000. Now both sides total will equal to 5,000. But we should also remember to record the closing balance as the opening balance for next period. So that will be our balance brought down with the amount of 5,000. And this concludes the second part of this question. We can now move towards the third one. We're given additional information. The direct labor cost included 3,000 for workers repairing factory machinery. So if they are repairing factory machinery, this will not be included in our direct labor because this will be our factory overheads. So let's subtract this amount of 3,000 for direct labor and add this amount of 3,000 to our factory overheads above. We have direct labor right here, so we subtract 3,000, but we add this 3,000 to the factory overheads of 85,000. All right. Then for the second information, office equipment cost 10,000 purchased in January 2022 was classified as factory machinery. Both office equipment and factory machinery had been depreciated at the rate of 10% per annum using the straight line method. So let's figure out the depreciation on office machinery in this case. So we have the cost of 10,000, and since this is a straight line method, we can just multiply the rate to this cost, and we have the rate of 10%, which means that the depreciation is going to be 1,000. And we were told that this depreciation is of office machinery or office equipment, right? But it was included or classified as factory machinery, which means that we included this depreciation of 1,000 in our factory overheads, which should not have been the case. So we're just going to subtract the 1,000 from there. That's going to be minus 1,000 right here. And instead, this should be included in our administrative expenses as this correlates to our depreciation charge in our office equipment. So that's going to be plus 1,000 right here. All right. Now, J Limited obtained a loan to buy a delivery van, and the interest on the loan 4,000 had been included in selling and distribution costs. So always remember that the interest charged is our finance cost. So the finance cost is of 4,000, and this amount of 4,000 should be now excluded from our selling and distribution cost. So that's going to be minus 4,000 right here. All right. Now we just need to prepare our manufacturing account for the year ended 31st December 2022. Let's write it down. So this is the manufacturing account, and it's for the year ended 31st December 2022. All right, and we can classify our manufacturing account into two different sections. So the first one will be our prime cost section, which will only include all of our direct expenses. So let's have a look above. In this case, the direct expenses is going to be the purchases of direct materials, which is given to be 216,000. Then we have direct labor, which is 196,200 minus 3,000, which results in 193,200. And then we also have our increase in the direct materials inventory. So this just means that our closing inventory is greater than the opening inventory by the amount of 1,160. And always remember that closing inventories are subtracted, and if there is an increment in the direct materials inventory, this amount should also be subtracted in order to figure out our total direct materials. So the total direct materials consumed is just going to be 216,000, which was what we purchased. Then we are just going to subtract the increment amount, and this results in the direct materials consumed to have 214,840. So let's start with this amount. There was 214,840, which was of direct materials consumed. We then had our direct labor. Let's have a look above. The direct labor was of 193,200. Let's write it down. And that concludes all of our direct costs, which means that we can just add these two and then figure out the total for our prime cost. That's going to be 214,840 plus 193,200, which results in 408,040. This will be our prime cost. Now the next step would be to add all of our factory overheads to our prime cost. Let's have a look above. Our factory overheads is given right here, and that's 85,000 plus 3,000 minus 1,000, which results in 87,000. So this is the amount to be added to the prime cost. Let's write it down. That's 87,000. This is our factory overheads. Okay, now let's figure out the total of our prime cost and factory overheads. That will be 408,040 plus 87,000, which results in 495,040. Now the next step would be to adjust all of our work in progress inventory. Let's have a look above. So the work in progress is given right here, and in this case we have a decrement. Always remember that in cases of inventories, if there is an increase, we always subtract it, and if there is a decrement, we always add it. So for inventory, increase means it should be subtracted, and decrease means it should be added. So we're just going to add this amount of 960 as decrease in work in progress inventory. Let's write it down. That is 960 as decrease in work in progress inventory. Now we can add these two amounts in order to figure out the cost of goods manufactured. That's going to be 495,040 plus 960, which results in 496,000. And this will be our cost of goods manufactured. Now we always need to figure out our transfer price in the manufacturing account, which means that we also need to add the factory profit. And we were given the rate of factory profit to be 20%, which means that the factory profit is just going to be the cost of goods manufactured of 496,000 times the rate of factory profit. This gives our factory profit to be 99,200. Now if we add our cost to the profit, we will get our transfer price or transfer value. In this case, that's going to be 496,000 plus 99,200, which results in 595,200. This concludes our manufacturing account as well as the third part of this question. Let's move towards the fourth one. We now need to prepare the statement of profit or loss for the year ended 31st December 2022. Okay, so this is the statement of profit or loss, which is equivalent to our income statement. And this is for the year ended 31st December 2022. Now the format is going to remain the same. What we're going to do is we will be starting with our revenue. Let's have a look above. The sales revenue is given right here and it's 936,000. So let's start with this amount. Then the next step would be to subtract our cost of sales. Okay, so the first item to be included in the cost of sales would be our opening balance of finished goods at transfer price. Then we will add our goods at transfer value, because in this case we have a manufacturing business, right? So that's plus goods at transfer value, and this is just going to be the value that we figured out from our manufacturing account. And then lastly we will subtract our closing balance of finished goods at transfer price. Okay, so let's start with the opening balance of finished goods inventory, which was given above. That is just going to be 26,400. We'll start with this amount. We then add our transfer value, which we just figured out to be 595,200. We then have the closing balance of finished goods. Okay, in this case, we only have the unrealized profit for the closing balance, but we need to figure out our transfer price. So we're just again going to use the same formula. We already have the profit to be 5,000. We don't have the transfer price. That is what we're trying to figure out. We have the rate of factory profit to be 0.20, and that's 1 plus 0.20, which means that 5,000 times 1.20 is going to be equal to transfer price times 0.20. So the transfer price is just going to be 5,000 times 1.20 divided by 0.20, which results in 30,000. So this is our closing balance of the finished goods inventory at transfer price. Let's include this in our statement of profit or loss. That's 30,000, which should be subtracted. Now let's figure out the total of the cost of sales. That's 26,400 plus 595,200 minus 30,000, which results in 591,600. Now we also have to subtract this from our sales revenue in order to figure out the gross profit. That's going to be 936,000 minus 591,600, which results in 344,400. That's our gross profit. Now the next step would be to add all of our factory profit back, right? So that's factory profit, which we've already figured out in our manufacturing account. That's 99,200. Then we also need to adjust the increment or decrement in the provision for unrealized profit. So what we're basically doing is we're just adjusting all of our profit from the cost of sales. The goods at transfer value includes factory profit, right? So we're adjusting it again. Now for the opening balance of the finished goods and the closing balance of the finished goods, we will be adjusting it with the help of our increment or the decrement in provision for unrealized profit. And we have already figured out our provision for unrealized profit account right here, and we have the increment in the provision for unrealized profit to be 600. Again, if there is an increment, we should be subtracting it. So let's subtract this 600. That's going to be increase in provision for unrealized profit. Okay, so let's add all these three amounts. That's going to be 344,400 plus 99,200 minus 600, which is also 443,000. Okay, now the next step would be to just adjust all of our expenses. In this case, we have two kinds of expenses. We were given the administrative and the selling and distribution costs right here. So we have the administrative expenses to be 234,000 plus 1,000, which results in 235,000. And our selling and distribution cost is 97,000 minus 4,000, which results in 93,000. So let's include these two items. That is going to be our administrative expenses of 235,000. Then we have our distribution costs, which was of 93,000. But remember that administrative expenses and distribution costs are the overheads, which needs to be subtracted. Now, if we are to add these three amounts, we will be getting our profit from operations. That's 443,000 minus 235,000 minus 93,000, which results in 115,000. Now, in order to figure out the profit for the year from profit from operations, we just need to subtract our finance costs. And we have already figured out the finance cost above, right here. That's going to be 4,000. And now, adding these two will give our profit for the year. So that's 115,000 minus 4,000, which results in 111,000. This is our profit for the year. Okay, this concludes the fourth part of this question. Now let's move towards the fifth one. The sales manager of GA Limited received a sales order at the value of 40,000 from a new customer in a country that GA Limited has never traded with. So this is the selling price in this case. Then the new order allows GA Limited to earn the same gross profit margin. Okay, but an additional 9,500 transportation costs will be incurred. Now we just need to advise the sales manager whether or not GA Limited should accept the sales order by justifying our answer and supporting our answer with relevant calculations. So we are already told that this new order earns the same gross profit margin, which means that firstly we need to figure out our effective gross profit margin. So that's gross profit margin. Let's have a look above. So we have the gross profit after adjustment of the factory profit as well as the provision for unrealized profit to be 443,000. This is the amount that we will be utilizing in order to figure out the gross profit margin. And then we have the sales value of 936,000. So that's going to be 443,000, which is the gross profit in this case, divided by 936,000, which is the sales value, multiplied by 100%. And this gives our gross profit margin to be 47.33%. Now, for this question or this new order, we have the sales value of 40,000. So let's figure out the increment in profit due to the new order. First of all, let's figure out our gross profit. So that is just going to be the sales value of 40,000 multiplied by our gross profit margin percentage of 47.33%. But also remember that we have to incur an additional transportation cost of 9,500, and costs should always be subtracted. Now this results in the increment in profit due to the new order to be 9,432. Okay, so the clear advantage of taking on this new order would be that our profit will be increased, right? Let's write it down. GA Limited will get an increase in profit, whereas this new order is in a country that GA Limited has never traded with. So whenever entering a new market, it might be quite risky due to the political regions as well as the foreign currency issue. Let's write it down. Entering a new market may be risky due to various factors such as political reasons or foreign currency exchange. Now, based on these factors, we need to advise the sales manager whether or not GA Limited should accept the sales order. Since there is an increased transportation cost as well as this is a new market, I would advise the sales manager not to accept the sales order. So let's write down that decision clearly. The sales manager should not accept the sales order on behalf of J Limited. Alright, this concludes the fifth part of this question as well as the entire question number 1 of 2023 February-March paper 3-2. If you found this video useful, make sure you like the video and leave a comment below, and make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.